Hello there. It is not raining where I'm at, but we are hearing lightning and we're seeing lightning and hearing thunder. So if you hear something in the background, it's likely to be thunder on the date that I'm filming this. So this is the first of our many how-to videos in the course, and this one explains how to do Form 1040EZ. So 1040EZ is a remarkably simple form that only certain taxpayers can use. And we're going to talk about how to prepare one based on a simple set of facts. So here we go. In our sample problem, Dick and Jane are a married couple, and so they're filing their taxes married filing jointly. Based on this alone, they can use Form EZ because you can only use it if you're single or married filing jointly and they meet that threshold. Dick is 30 and Jane is 28, and they both can see. So here's another reason that they can do a Form 1040EZ. Both are younger than 65 years old, and neither is blind. They have no dependents, and you're not allowed to have dependents and filed Form 1040EZ. So far, so good. They're able to use a 1040EZ. All right, so here's a few more facts about their case. Their total taxable income is $70,000. And so this is okay. They still can use the Form 1040EZ because their taxable income is less than $100,000. All of their income is wages. So to use Form 1040EZ, your income can be wages, salary, tips, unemployment compensation, or tax-exempt income is what that should say, not tax income. Tax-exempt income is less than $1,500. Well, they meet this threshold because all they have is wages. They're not able to claim any credit other than maybe earned income credit. And that means they're still okay because to use the Form 1040EZ, you can't claim any other types of credits except earned income credit. So this brings me to a very simple answer to a question many people have, and that's what's the difference between a deduction and a credit? So this is remarkably simple as a mathematical idea. A deduction is something you reduce your taxable income by to make your taxable income lower. And then when you multiply the taxable income times the tax rate, that means you'll pay lower tax. Now, contrast that with a credit where if your tax bill was $500 and you have a $100 credit, you now reduce your tax bill. 500 minus 100 is 400, and only you have less tax due. So I tell people that usually the tax credit is a better tax minimization tool than a deduction, but always you should look at the amounts involved, especially if you have a choice to do either one. So here we go, actually completing the Form 1040EZ. So on line 1, their taxable income is $70,000. They don't have any tax-exempt interest, which would have been in line 2. No unemployment. I'm sorry, it's not tax-exempt interest. They didn't have any interest from anything. So sometimes with a bank interest, you might have that in that space. So going back even to what I said earlier, it's not tax-exempt interest that's the issue. It's earnings from interest. And if you think about it at modern rates, a person would have to be very wealthy and probably earn a lot more than $100,000 if they had interest that was greater than $1,500. So with no unemployment and no interest that could be taxed, the adjusted gross income for them is $70,000. And although adjusted gross income doesn't mean anything major here, it's a pretty important tax topic. So this is the final adjusted gross income before we start subtracting deductions. So you may have heard, and indeed you'll understand well by the end of the class, that a person usually has a choice to file a standard deduction, or they can do what's called itemized deduction. So when you hear about things like deducting interest on your house, deducting church contributions, and this kind of thing, a person's choosing to itemize. Well, if they don't have enough deductions to make that worth their while, IRS gives them some simple deductions they can use instead. And so they're not allowed to itemize deductions on Form 1040-EZ, but Dick and Jane aren't going to do that anyway. And as a married filing jointly couple, their standard deduction is $20,600. So line 6, they're going to put their taxable income, and that's $70,000, their adjusted gross income, minus the $20,600 standard deduction, and their taxable income is $49,400. Now, these two probably got W-2s from their employers showing that they had withholdings of $9,000. You might, for example, imagine they each make the same amount of money and they both had $4,500 withheld from their check, and that means that they've actually set aside $9,000 to pay their taxes. There's no earned income credit here, and if you were to look in your book at Table 9.3, page 925, you'd notice that the earned income credit phases out completely at $20,330. So with them earning $70,000, they're way above the $20,330. And you can go read about the earned income credit. This is not really a video about that, but I will tell you that earned income credit is designed to help working people, particularly with families. So if there turned out to be children, this number of $20,330 would go up quickly. So you might run into people at $70,000 worth of income who can claim earned income credit, but not people with no dependents. So here's our basic tax calculation. In line 8B, there's no combat pay. So we're adding up line 7 and 8, and we come to the $9,000 that the two of them have withheld. You can tell from the way this works out that if a person did have combat pay, which we have a lot of in Hampton Roads, you would add that as if the person paid more in tax. But it didn't happen here, so they've paid $9,000 already. Their taxable income is $49,400. From Appendix F, I'm showing you that if a person has taxable income of $49,400, you would use Schedule Y-1, which is a married filing jointly schedule. Their base amount here is $1,845. That's base tax. And then they turn around and they subtract the taxable income minus the $18,450 that the table tells them to take. They come up with $30,950. Multiply that by 15%, come up with $4,643. They add these two tax numbers together, $1,845, $4,643. They come up with $6,448 of tax. And notice they get a refund. So all of you who might clamor for big refunds, consider carefully how this couple got into a position where they got a refund. They paid $9,000 in tax. So when they only owed $6,448, they got some of their money back. So if you owe a lot of money in taxes, then if you pay more money, you're going to get some back. So many people think that refunds are like free money. And I'll give you that with things like earned income credit, sometimes they approximate real money. But usually you're going to get a refund if you put money in. Not if, a tax preparer didn't do your return right or something like that. It has more to do with whether you put money in or not. Well, anyway, take care and let me know if you have questions.